Welcome to this event with Hafnia. Welcome to you, Michael Skov, CEO of Hafnia, and releasing Q1 results today. My name is Tue Østergaard. I'll be the moderator for this. I am with HC Andersen Capital. We will take approximately 20 minutes, and feel free to ask any questions you have in the chat room below. If you have any questions, please ask them. I'll put them through. I'll try to phrase them as good as I can, and then we'll take it from there. But today's event is primarily about the Q1 and of course the industry as such, and it's hugely interesting. Just to give you an introduction, right now the stock is up 65%, Michael, in this year, which is quite uncommon, I would argue, and so is your results, by the way. But we'll get into that. Welcome.
Thank you.
So let's just take the brief introduction here before we go into the real thing. I don't know if you want to give a brief introduction.
Yes, so thank you for this. Well, basically, I mean, Hafnia is a fully integrated ship owner. We are 100% focused on transporting refined oil products. We operate own ships, but we also operate vessels that are owned by third-party owners that have basically outsourced it to us to manage. So as you can see from the old description on the left side, there's a couple of what we call key value propositions. And besides the company structure in itself, we're also a platform that has the lowest cost of funding, the lowest cost of SG&A, i.e. administration cost in general. And we have other revenue stream models that I mentioned before, which is basically related to us performing certain services for third parties, and that generates quite a substantial amount of fees, all of which goes to the shareholders' bottom line. So it's fully integrated. There's nothing outside. We own and time charter in, so financially, if you like, employ 139 ships. We are listed in Oslo under the ticker name, as you can see bottom right, Hafnia. Young fleet, 7.7 years, which should be compared to an average product tanker industry fleet of above 10 years. And as you mentioned before, the value of the company has gone up quite substantially, but on an NAV basis, today it's around $1.4 billion.
Cool. And then let's go into, before we get into the results, this was what you did. I guess that's post balance sheet date. You did a capital raise of $100 million. Maybe just a brief introduction to why actually.
Yeah. Well, so I mean, basically, our expectations, and I think we've talked about this even with you guys a few times last year, was that we were entering a time in the product tanker sector where there would be a limited supply of vessels coming into the sector, at the same time as you would have more vessels leaving due to age, but more importantly, you would have a rebound of demand for refined oil products coming out of COVID-19 situation. So those three things in general had given us a clear view that the market was in for an uptick and an adjustment upwards. So because of that, we wanted to modernize our fleet, but also expand our exposure to the product tanker sector. So on the back of that, we on the left side of this slide, we did two strategic transactions end of last year, early this year. The first one was 32 ships, which were acquired through a share transaction from CTI and a company owned by Oaktree. So basically, we didn't use any cash. We basically took over the company and paid in Hafnia shares. And the bottom left transaction was an acquisition of 12 LR1 vessels, again very modern, from one of our competitors, Scorpio Tankers. And this was again arranged through 100% finance, but at very competitive terms. So at 200 basis points or 2% in interest, and with purchase options, so we can buy them back basically every month throughout the duration of the finance. So we did those two transactions, as you can see, without putting in any equity, and therefore coming into this market, seeing our share price come up and come very close to NAV, we thought it was prudent to raise $100 million to basically refinance, particularly the first transaction, CTI, and make sure that we reduce the debt and come back to that leverage that we prefer to have going through the cycles overall.
Cool. And you did that around 25 Norwegian kroner, was that, as far as I remember? And now we
That's
are
correct.
close to 29, so that's fine. Okay, so this is how you're going to do it in the future. That if you want to keep a certain amount of debt, and every time you go above that, you will raise cash. Is that
So
how
basically,
we should interpret?
yeah, I think basically, I mean, our philosophy is and our strategy is based on, let's say, many years of having dealt in this market, is that if you want to have an exposure to the spot market, which we want because it's proven historically that being spot market exposed versus chartering out all your vessel gives you higher return through the cycles, then you can't and you shouldn't combine spot exposure with a high gearing leverage of the company. So, we did those transactions because they were available and it made sense at the time. But now that markets are picking up, we will also make sure that we over time bring down the leverage, as you say, to levels where we can go through and weather any markets like we saw last year, where a really poor freight market didn't really have any material effect on Hafnia overall.
No. Fair enough. Then let's do a quick Q1 summary. I mean, the number speaks for itself. I mean, you can see the leverage on your business model here with the higher revenue and higher EBITDA. Is there anything you think is, highlights comes to your attention here?
So I think, I mean, quite frankly, Q1 was not a great quarter overall, right? And if you look at a peer group comparison, I think there was only one more company engaged in this trade that actually came out with a small profit. The rest were really loss making. So I think this kind of just reflects what I just said before, that it's important to have a competitive cost structure so that even when things are not perfect, you're still able to produce value for the shareholders. So what this really reflects is 2 bad months, January, February, and 1 stronger month in March when markets started to pick up, and kind of we've seen that now going into Q2.
And then you reintroduce, I would argue, dividends. I guess it's a 50% payout, and that's just, I guess that's politics. That's what you've told the market before, isn't it?
Yeah.
Yeah.
So I think it's well, as you say, we didn't reintroduce. The policy was always there. We just didn't have made any profit last year,
No.
but for sure, right? And I think we want to stick to the commitments we've made. So the policy is what the policy is until it's being changed. And I think as far as we're concerned, we are very well positioned in Hafnia now with these acquisitions that we did. We have a very strong fleet, a very, very strong earning capability. So to be honest, the focus is really now about returning capital in any form and shape to the shareholders, rather than us running out and spending money on buying new ships. So that you will not see.
Okay. And this is quarterly dividends, right? So if you have a profit in Q2, Q3, Q4, we'll get dividends accordingly. Is that the way we should take it?
Yes, but the dividend policy is annualized, right? So in other words, that it is based on that we, when the year is over, have paid 50%. So in other words, if you see that certain quarters are changing as you move forward, you could choose to do different ratios. But yes, so the policy is on an annualized basis to pay out 50% of net profit.
Okay, cool. Yeah, but that's history. And now
Yes.
into the forward-looking statements. The only thing that the 70, this is about the coverage of your shipping, of your fleet. And Q2, you have 70%. But, for me, it's interesting to see you only have 29 and significantly less in 23. So perhaps go into that a bit and tell us a bit about why is this. It's of course very relevant right now, but yeah, please.
Yeah, so basically, we had not taken any significant coverage whatsoever in Hafnia. For all the reasons that I mentioned earlier, we expected to have a better year this year, and actually the next few years coming as well. So we had a very small coverage, which was basically only based on our biggest ships, LR2 ships, because we didn't have so many of them. So we decided to use them as a hedging instrument. But other than that, we have basically been fully exposed to the spot market, which is kind of what you're seeing now coming back, is that we have, almost a full exposure going forward to the spot market. And that will have a great effect on the earning capability for sure.
Yeah. And the 29, is that a normal, or is that sort of above or under where you would normally be?
Well, that coverage that you see in the 29% also reflects part of Q2, right? What we have already done going forward.
Okay,
So I think what you need to think of is that, give you an example, when Hafnia entered into 2022, I think on an average basis throughout the year, we probably had about 7 or 8% covered of the year. That was all. So we had basically 92% exposure to the spot market. And that hasn't changed as such. So it's not like we have done any long-term coverage yet. So the vessel has just been fixed in the spot market, and that's kind of what you're seeing here, the result of.
Cool. And then, I mean, below you have these improvements in rates, and obviously they've gone up a lot recently. So where are we today, for example, on LR1?
Yeah, so basically, we are basically where the numbers are showing you here, right? So as you can see, it's close to $60,000 as refers to. What we try to do here is to put in as updated numbers as we could, as you can see, for the week starting Monday 16. So those numbers you see there are the numbers that we have seen in the spot market. And well, just to add a comment to it, I mean, I think the key element really when you look at these markets and people, also investors that have been in these type of shares before knows this, that what you really need to look for is this a fundamental strength? In other words, is it geographical restricted? Or are we talking about a global market where you're making money in every area? So I think when you look at these three sectors that we illustrated here, the important part, and I think what kind of maybe undermines our own positive view on this, is that it's not about being positioned only in the West or only in the Eastern Hemisphere. Markets are strong everywhere. So, we're not seeing that risk normally where everyone can kind of go from one area to another and then ultimately will ruin the market. Right now, you're actually making money irrespectively of which geographical market you're in.
That's very interesting. And just you introduced this one. I found that very interesting. I think this is an attempt to give some kind of sensitivity on the rates. And then
Yes,
if I read it correctly, assuming that the rates stay where they are, you would make $850 million on net profit.
that's correct.
I mean, that's half the market value as far as I can see, or more.
Or more, yeah.
And then if you have 490, that would be on the cover rates as where we are today, I believe.
Correct. Those were the Q2 covered rates that we spoke about before.
Yeah.
And a lot of this, of course, also is related to. So if we take these two transactions that I mentioned before that we just did just around the turn of the year, I mean, those two transactions alone added about 13,000 earning days to Hafnia on an annualized basis for 2022. So you can say 13,000 days and say $10,000 per day, which we are beyond now, but just to take a round number, is obviously quite a massive contribution to the bottom line for having done an investment without paying out any cash and basically putting that into a market like this.
Yeah.
This is part of the reason why the numbers now suddenly are becoming as big as they are.
Yeah. Fair enough. But this is really overwhelming, big numbers, right? In that case, I believe. Of course,
Yeah.
I think what's struggling and puzzling me is how much is structural and how much is because of this very, very strange situation in Russia and in world markets globally. Is that a fair question, Michael? I think it's very difficult to find out actually what is what.
And I think that's right, and I think that's a very fair question, and I think maybe if we kind of just take it from the bottom up, I think a few things that were fundamental and that were already here before the invasion in Ukraine was the fact that inventories had been drawn down, and I do believe we spoke about it the last time as well.
Yeah.
But what's really important to understand is, thank you for that.
We have
is
it
that
here, right?
when you draw down oil inventories, as you see on the left side of this slide, and basically you have to remember we are delivering a finished product. So basically we deliver the gasoline, the diesel that people use every day. So it's not like you're not going to spend 2 or 3 months to prepare for a finished product. We have it, we are transporting it. So the first industry to feel the need when there is a bit of panic will be our trade. So basically what we saw happening is, as there suddenly was a sanction on oil, people started to scramble to get the finished product. So what typically happens in our trade is that vessels start to sail longer, and they are doing inefficient transportation. So instead of going from A to B, they will quite often go from A, jump to C, and back to B, and vice versa. And that means longer distances for ships. That means vessels are tied up much longer. But it also means that you don't know where this vessel is ending up next, which means you cannot even use it for the next cargo. So if you kind of look at this going forward, you're creating so much uncertainty in the product tanker sector overnight when you have low inventories and a sudden need for getting the finished product delivered early.
Okay. But I guess the ton-mile effect is structural. I mean, we will not import any diesel from Russia anymore. That's
exactly
over.
So I think that was the starting effect. Basically, any geopolitical incident would have caused this market to move up, basically because inventories are low. And that means once you start panicking a little bit, you have no buffer. You can't take it out of your inventory next door. I think the Russian situation is interesting because, as you mentioned, yes, of course, when you lose oil that is traveling very short distance and you replace it by import to Europe from longer distances, of course, that has an immediate effect. But with the political environment now having decided to make Europe independent of Russian oil and gas, I think it's fair to say that a big volume of that will now be structural rather than just linked to the current geopolitical situation in Russia and Ukraine.
So there's a guy here asking about the Ukrainian the market upturn against the decreasing inventories already. I guess you have explained that in a way, but it is also true perhaps that, and you used the phrase leans toward the positive in your saying, and I thought that was understating a bit in terms of how the rates are doing. But what I mean is that we have this inflation fear, and we have this risk of consumers globally using less oil. So where do you see the balance between this horrible war and the stop from Russia import, and then you have the whole situation on the consumer side?
Yeah. So I think a good comparison actually is, and it's not just because of the war, of course, it's mainly due to the inflation scenario that we're looking into and potential reduction of global growth and with that also global oil demand. But if you look back to, for instance, the financial crisis, following that, the global oil demand did not drop more than maximum 2 to 3%. And people, I think, have had the impression it was more. It wasn't. And I think what we're seeing now is that the ton mile in itself is probably closer to 6% that's been added to the demand side. So even if you had a similar situation of oil demand dropping 1 or 2% overall, the ton mile would actually, as things stand, make up for even more of that going forward. So the key element here is really that it's difficult to predict what strong market means in terms of dollars per day if you look at a 3-year period. But with the current low inventories, with no new build coming in of significant size and no one investing in them, it's fair to say that what you see today, what you have of supply of ships is what you have. At the same time as you are having more ships being phased out, but also having a rebound of oil demand considering the COVID-19 situation we've just been through.
So just taking that order book, we've discussed it many times, and it still looks flat. And is there any change foreseeable? I mean, they're all building container ships out there in China and Korea or Japan. I don't know, but that's my impression.
They are, and if we go out today and we want to buy a standard design product tanker, which nobody really wants, because why would you want to buy an asset that will last for 25 years when you know the world is moving in a direction, at least when you come further out? Prices are extremely high because the yards are not really making money on building product tankers or dry bulk carriers for that matter. So in a normal market like what we're seeing now, I would be able to go out and spend some of all the money we're making now in Q2 on a new build, and I will probably get that ship delivered by the end of 2023. Right? That would be a normal situation. So what you will see right now is that most owners would run out, spend the money again, buy more ships, and by the end of 2023, early 2024, the market will probably contract a bit because there will be too many ships. If I do that now, the shipyard will tell me you can have it in 2025. So we are at least a year and a half further out, which means I have no guarantee of earnings out in 2025 because there's no forward market I can log anything in. That's the big difference.
Cool. There's a gentleman here who asked what the rising interest rates, how does that affect you? Because I guess the way you finance ships is also a bit, very impacted by the interest rates. So it's a very good question actually about effect of interest rates both on new build prices but also on you as a business.
Yeah, no, absolutely, and I mean at least we've had a very, very strong starting point in terms of as you saw earlier of having very, very low finance cost. So that has been an advantage for us. But we've also had an ongoing hedging, which at the moment is above 60% a hedging of our interest rate. So I think we've been very prudent when it comes to that. So therefore, there will not be a material effect on Hafnia since we have covered a very, very high percentage of that cost going forward.
Cool. But this actually looks the same as it did half a year ago. There's not much change here as far as I can see. Is that fair to say about the order book versus the order book?
Nothing has happened, and people will not buy a standard design for delivery in 2025 at the moment. What you may see people do at some point is to buy vessels with dual fuel propulsion, which means that you will make them ready for burning other oils. But right now, just to give an example, that ship would cost you $50 million to build, and that is against what I would call a normal cost of an MR product tanker of maybe 32, 33. So we're talking about a $17 million premium for the same ship, same everything, deliver in 2025. So there is no business model at the moment even remotely justifying that.
Cool. ESG was very hot last year. This is just the final remarks, and all shipping companies, including yourselves, are very focused on delivering up to zero emissions and stuff like that. Has that changed with all the current events?
Not as far as we're concerned, and I think that the whole ESG discussion, at least from all my conversations, is also very geographically diversified. So in other words, I think in Europe, Scandinavia, there's quite a lot of focus, and we have very good conversations about it. To a lesser degree, if I move east or to the US, but for us, that strategy doesn't really change in terms of it's not a public market thing. It's actually more about how we choose to run the company, which is all based on it's a value-based leadership model we have. So for us, this is an ongoing thing. The environment is obviously on everyone's mind at the moment, but we have equally much focus, quite frankly, on the social part and on the governance part. As far as I'm concerned, investors and others should look much more into governance, because that's quite frankly there where it all starts. If a company has great governance, automatically you are going to get the E side, the environmental side to follow, because that would be interlinked by definition.
I think we'll follow up that many times from now on these conversations. Michael, there's a guy asking how hånd på kogepladen in Danish. How many shares do you own in Hafnia?
Yeah, so I think you can probably look that up, right? What I have of shares and options, and it's in the annual report. Or I can say so much is that I have so much at stake for a strong share price in Hafnia that it will have more than a material effect for me whenever the share price drops, and obviously also the other way around. And this comes all the way back from we started Hafnia in 2011. So you can say one thing is that I will be the first one to suffer if Hafnia for some reason should not perform well on the share price.
Cool. So you do have hånden på kogepladen, as we say in Danish.
A lot.
Yes. Okay, Michael, thank you very much for your time, and I hope you gave a rundown, and I hope you felt what we went through, all the necessary things. Thank you very much, Michael. Have a good day. Thank you for listening in, and this will be available after hours too. Thank you very much.
Thank you. Thank you.